IREN stock had a rough day on Thursday. The stock didn't just fall, it broke decisively below the $50 level, closing the session at $48.65, down more than $7, or around 12.5%. On any day, this would be a dramatic move. But coming on top of the heavy selling we've seen over the past week, this drop adds a new layer of intensity to the story. It leaves investors asking the same questions. Is something new going wrong, or is this what happens when a high-growth stock undergoes a massive reset? Is this a red flag signaling deeper risk, or is it simply a shakeout that sets the stage for the next big move? Before we dive into the implications, let's start by acknowledging the broader market environment. Thursday was a tough session across the board. Tech stocks were down sharply. AI infrastructure names in particular took a hit. Rising yields, macro fears, and a shift toward defensive positioning drove a wave of selling. So, part of IREN's decline today was simply being caught in a market that decided to dump risk across the board. When the entire tech complex sells off, especially the more volatile names, IREN is one of the first in line to feel that pressure. But the size of today's decline suggests that this wasn't just a case of following the market lower. There's more underneath the surface. To understand what's happening now, we have to zoom out and look at the last 2 weeks. IREN had become one of the most talked about stocks of the year. The company surged earlier in the month as excitement over the $9.7 billion Microsoft AI cloud deal pushed the stock to all-time highs. The pivot from Bitcoin mining to AI infrastructure was seen as bold, ambitious, and highly strategic. Investors piled in. Analysts praised the long-term potential. Social media declared IREN one of the next big AI winners. And at its peak, the stock was up more than 500% year-to-date. But rallies like that create a new problem. They create expectations. And once expectations get too high, the market eventually demands clarity. When IREN reported earnings last week, the results were fine, even strong in many ways, but they weren't the kind of perfect numbers the market was hoping for. Costs were rising. Depreciation was climbing. Share-based compensation was up. Revenue recognition for the Microsoft deal wasn't clearly broken down. And the timeline for when the new GPU infrastructure would meaningfully contribute to earnings remained blurry. None of these were fatal issues. But for a stock priced for perfection, they mattered. That's where the selling began. First it was a pullback. Then a continued decline as investors reassessed. Then concern grew as the stock broke trendlines. And now, with today's sharp drop below the psychological $50 level, sentiment has shifted from correction to fear. Technically, breaking below 50 matters. A lot of traders use round numbers as mental anchors. Some set stop-loss orders under those levels. Others use them as signals of strength or weakness. When a stock falls through a major round number with force, it often triggers mechanical selling. Stop-losses get hit. Algorithms step in. And panic selling can intensify the move. But it's important to highlight something that many investors miss during fast declines. Big moves often blur the line between what is caused by fundamentals and what is caused by mechanics. Today's decline was not driven by a new negative headline about the company. There was no deal cancellation. No regulatory issue. No sudden earnings revision. Nothing fundamentally changed within IREN itself. The selling was driven by a tough market, a fragile investor base, and a technical break that reinforced downside momentum. When you combine those factors, you get days like today. Now, let's talk about the emotional side of this move, because this is where the narrative becomes fascinating. Every great growth stock goes through periods where sentiment flips from "this is unstoppable" to "this might be falling apart." These flips almost always happen after parabolic runs. For IREN, the hype surrounding the Microsoft deal and the AI compute story generated enormous enthusiasm. Investors weren't just bullish, they were euphoric. And when a stock rises on euphoria, it almost always falls into despair on the way down. The cycles are exaggerated because the emotional investment becomes part of the valuation. But if we step back from the day-to-day noise and look at the long-term picture, this is where figures like Eric Jackson provide perspective. Jackson has been one of the clearest and most consistent voices arguing that IREN is not a short-term trade, it's a long-term infrastructure growth story. He believes that the Microsoft deal was not a fluke or a one-off. In his view, it validates IREN's position as one of the new AI infrastructure players that will help power the next wave of artificial intelligence. Jackson repeatedly points out that AI compute demand is growing faster than supply, and that companies like IREN, which provide energy-efficient GPU data center capacity, will be essential for hyperscalers in the coming years. From Jackson's perspective, the current decline is not the story. It's the noise around the story. His view is that early winners always experience massive volatility before maturing. He often references companies like Nvidia, Amazon, and Tesla, companies that endured steep, painful corrections during their early build-out phases, only to become dominant leaders later. Jackson believes IREN's long-term trajectory is similar. The company is in the middle of a costly expansion. It's building data centers. It's deploying next-generation GPUs. It's scaling at a pace that naturally increases short-term expenses. These pressures create volatility, but they also lay the groundwork for future profitability. So the question becomes, what's real and what's reactively emotional? The real elements are clear. IREN is spending aggressively to build capacity. The Microsoft contract requires heavy upfront investment. Operating expenses and depreciation will rise before revenue ramps. There is execution risk, and the company must prove that its business model can scale efficiently. These are legitimate challenges. But they are also typical challenges for companies transitioning into large-scale infrastructure roles. The emotional elements are just as clear. The stock rose too fast. Expectations became too high. Traders priced in years of flawless execution before the first GPU deployment even occurred. When reality showed that the company is still in an early phase, the stock reacted violently. Now the pendulum has swung the other way. Fear is overtaking logic. Short-term traders are dumping positions. And the market is conflating a normal early growth struggle with a broken thesis. This is where an honest, balanced interpretation matters. On one hand, the drop below $50 is not something to dismiss casually. It signals that sentiment has shifted and that the stock has entered a period where investors will demand visible progress before rewarding the company with higher prices again. On the other hand, nothing about today's drop tells us the long-term foundation has collapsed. It's still the same company. It still has the same contract with Microsoft. It still operates in a sector where demand is exploding. And it still has long-term potential if it executes. So what should investors be watching now? The key is execution milestones. Updates on GPU deployment. Construction progress at the Texas campus. Early revenue contribution from AI compute services. Any signs of new partnerships beyond Microsoft? These are the signals that will determine whether today's price represents a value opportunity or a warning sign. If IREN begins to hit these milestones over the coming quarters, sentiment can flip quickly, just as it did on the way up. That brings us back to the central theme of tonight's video. Is this breakdown or opportunity? The truth is, it's both, depending on your time frame. For short-term traders, breaking $50 is a red flag that momentum has shifted and risk is high. For long-term investors who believe in the structural AI infrastructure story, and for those who echo Eric Jackson's view that this is an early-stage winner, this could be the beginning of a longer consolidation phase that eventually forms the base for the next major move. The coming days will be critical. If the stock stabilizes around the mid-40s and begins to build support, this will look like a washout bottom. If it continues to fall sharply, traders may reassess the timeline for recovery. But the most important thing to understand is that today's drop wasn't caused by a broken business. It was caused by a broken mood. And moods change faster than fundamentals. To close out, here's the balanced view. Yes, today's drop is serious. Yes, the break below 50 matters. Yes, the stock is facing real execution risk in a tough market. But the long-term story behind IREN, the Microsoft contract, the shift to AI compute, the growing demand for GPU infrastructure, remains intact. If you believe that the future of AI will depend on companies that build and power high-performance data centers, then today's move is not a sign of collapse. It's the setup phase before the next chapter of a much larger story.